comes in and basically starts the dumbest trade war in the history of this country. This is going to be about potentially millions of people losing their jobs. It's going to be about millions of people losing their savings, many of people losing their retirement security, and at the same time taking on even higher costs for everything they buy. So that's going to push us in potentially to foreclosures or people being pushed out of their apartments. You know, I remember this from 2008 and how long it took us to dig our way out. And to this day, there are families, there are communities that still haven't recovered. Recessions can be all those fancy charts and graphs, but at the end of the day, people feel them one person at a time, and they can be devastating.
Several months later.
The first read of second quarter GDP coming in at 3%. Consumer spending coming in higher by 1.4%. But again, this is higher than expectations. Again, GDP, this is the first read of the second quarter coming in at 3%. That is better than expected, 2.4%. I want to bring in Adam Johnson. Markets are certainly watching this right now.
Yeah, Goldilocks, because I would add to that, Cheryl, that the GDP price index was only 2%, and the expectation was 2.2. In other words, we have an economy growing at, what do you say, 3%. We have inflation at 2%. That's the best of both worlds. So I'm very positive on that report, at least in the moment.
Nick,
the left and people that don't like the president and don't want things to work. And, you know, like Senator Elizabeth Warren will come on and say inflation's out of control and the economy is getting killed by what's happening by these tariffs. This 3% with the market at new highs and really we haven't seen inflation, you know, go up back to 3%. Maybe it will this week. Maybe we'll see it. But none of these horrible things have happened, but they still talk like it's happening. It's amazing.
Well, there's an important lesson there. Don't pick a congressman to be your money manager. That's what I would say. But in the end, Congress has their own reasons to point out certain things. And the Democrats, of course, as you pointed out, really don't want to see the current administration have some success. But there's no doubt that this is some success. We're seeing more horsepower. We're seeing better equities. Inflation really hasn't changed much in the last year or so.
Plans for the economy would accelerate inflation and invite a recession by the middle of next year.
Increase inflation and by the middle of next year would invite a recession. Increase inflation and invite a recession by the middle of next year.
A recession by the middle of next year.
To a recession by the middle of next year. Recession by the middle of next year.
Recession by the middle of next year.
A recession by the middle of next year. A recession by the middle of next year. A recession by the middle of next year. Recession by the middle of next year.
Under his reckless leadership is that costs aren't going down in America. They're going up. Inflation is going up. The stock market is going down. Consumer confidence is going down. And the retirement security of the American people is going down. This is not Liberation Day in America. It's Recession Day, because Donald Trump's reckless policies are driving us toward a painful recession.
Palpable panic on Wall Street, red numbers and worries about something else that starts with an R, a recession.
What we're doing is very big. We're bringing wealth back to America. That's a big thing. And there are always periods of, it takes a little time. It takes a little time.
He's talking about that period of transition is what he's talking about is his firm belief that tariffs are going to be the main way that the United States brings in revenue. Never mind what they do to the prices that people actually pay when they purchase goods in a global economy. I mean, Scott, virtually no one who understands economics believes that tariffs are a good idea.
Alluding to, what do you make of that? Is Biden to blame, or is it the Trump tariffs?
Well, you know, these are absurd statements from Trump because this is 100% related to his exact policy changes that have caused this surge in imports, this recession that has begun. And I'm calling it a recession now because I can see it with our clients already. People are preparing for the worst, and that means they're not spending, they're pulling back, businesses are pulling back, home sales are not happening that would have happened. Leases that would have been signed aren't being signed. So we're seeing negative economic activity because of Trump's actions already. So the next 3 months might not be so bad, actually, because people have prepared, companies have brought in stuff now to try to, cushion this in hopes that maybe something will be reversed quickly enough to avert the recession we're going to see. But this idea that Trump thinks he can manage a recession or, a little pain isn't so bad, this is very ignorant thinking. This can cause a very, very deep downturn in the United States. We're like a very big ship. So when we're going in the right direction, that's great, like we were under the Biden administration. But once the ship turns, it's very hard to turn it back. So this is not a game you want to be playing, and it's one that's never really actually been done with the U.S. economy. And I cannot come up with many scenarios where this works out well, even in the best case, and we get all the trade deals. A lot of damage has already been done.
In the United States has said yet again that he's okay if his policies cause a recession. That's going to cause a lot of pain in the short term for workers, for families, for small businesses all across the country. And I think what is especially daunting listening to this statement from the president is that he is actively doing so many things that will make a recession that much more painful. When you think about the chaos that Doge's chainsaws had across the federal government, you think about the cutbacks that they are putting forward in their budget, you think about the fact that he's focused on a tax plan that will put billionaires over families. If we have a recession, it's going to be even worse because we won't have the supports there to help families get through it.
And what I need people to understand is that $5,000, even if you get it, it's not going very far because we are headed to a recession. That is the bottom line. People talked about how terrible the economy was, and that was more so like things were expensive, but people were absolutely able to still enjoy all these plane rides because every time I caught a flight, it was absolutely packed, right? And so, yes, it was expensive, but you could pay for it. You're going to end up in a situation where you're not going to be able to afford the food. Right now, you're getting rid of the people that labor in the fields.
Seconds away from that advanced second quarter GDP number. Futures are higher ahead of that, with the Dow futures up by about 25 points. S&P futures up by 7. The NASDAQ indicated up by just over 40 points. Rick Santelli is standing by at the CME in Chicago. And Rick, take it away.
Yes, these are the advanced, of course, so they will be modified. But we are expecting a number around 2.5%. Last quarter, you do realize, was down 0.5%. That was the weakest quarter since the first quarter of 22. And they're out up 3%, better than expected. That would be the highest level since the third quarter of 24 when it was up 3.1%. On the consumption side, up 1.4, very close to estimates. Up 1.4 would be the best since the last quarter of 24. And I do want to point out, if you look at the consumption numbers for last quarter, up 0.5%, that is really weak. As a matter of fact, that goes in comps to the worst, darkest days of COVID when it was down 30%. However, I wanted to know, outside of COVID, when was the last time we saw consumption that low? You're going back to June of 2011. Just as a footnote, on the pricing index side, less than expected. We're looking for a number over 2%. This number is at 2%. 2% would be the lowest pricing index number read going back to the third quarter of 24 when it was 1.9%. And finally, the core personal consumption expenditure price index, that's a quarter over quarter number, expected to be around 2.3, comes in a little heavy. This one's a little heavy at 2.5. 2.5 would be the highest since the last quarter of 24 when it was 2.6. So very good news all in all, especially considering that Liberation, April 2nd, falls in this quarter, and it was definitely better than expected. Now, does that mean there can't be some payback in the quarters ahead? Possibly, but nobody ever knows what the quarters ahead are.
3% growth on an annualized basis, just reported for the second quarter. 3% growth. That is better than expected. It's stronger than expected. So where's the recession and where's the impact of tariffs? I don't see it in that report. Do you?
No, Stu, I don't see it. I mean, the tariffs have been generating a tremendous amount of revenue. We've got record readings in July. We could be upwards of $300 billion in revenues for the year. Even the CBO, which has very pessimistic forecasts, they think GDP isn't even going to grow 2%. Even the CBO thinks we could generate about $3 trillion in revenues over the next decade. So we've got the revenues. The inflation is de minimis. We saw a big recovery in growth in the second quarter, powered by a couple areas. One is a real improvement in the trade deficit. It shrunk. We expect that to continue given all the trade deals that the president has put forward. And this CapEx comeback, capital spending grew 5% in the quarter. It's grown at its fastest pace since the second half of 2011. I wouldn't be surprised if those numbers actually get revised up to show an even bigger boom. But now that we've got the one big beautiful bill, all the capital expenditures, all the investment in the economy should continue and really kick into gear this half.
I've been asking, will we get 3% growth in the fourth quarter of this year? Well, it looks like we've got 3% growth in the second quarter of this year. So project forward, could we get 4 or even better than that? 4% growth, fourth quarter this year? What do you think?
That would be great. I mean, in President Trump's first 3 years, growth was nearly 3%. And in that 2019 year, before the pandemic struck, growth was running at almost 3.5. So we certainly could generate 3% type growth. We already did it in the second quarter. With productivity improving dramatically, it happened under President Trump. And all these new innovations, at the outset, we talked about crypto. It's going to increase financial efficiencies. There's no reason why we can't grow much faster than what we've been growing at over the previous 4 years. 4% would be great, but I think 3% is a good number, too.
So this morning, we got more worrying news showing how Donald Trump's administration is raising costs and sowing chaos in the economy. The New York Times headline put it succinctly: U.S. economy slowed in the first half of 2025 as tariffs scrambled data. And while the Trump administration will try to wave rosy headlines about the Q2 number, today's GDP number is in fact a mirage because some ominous numbers lurk under the hood. Business investment plunged in the second quarter by 3.1%. The fact that business investment plunged so starkly is very troubling. It shows that already businesses are worried about growing their operations, worried about hiring more workers, worried about trading with their international partners, and worried in general about the future. And this number is another data point in a larger pattern. Donald Trump's tariffs are weighing down the U.S. economy, spiking costs for small businesses and families alike. And if Donald Trump keeps up the chaos, the dangers for the economy will continue to get worse.
This moment, the market's up a very little bit, basically opening flat on this news and a lot of other stuff going on. With us now is Madison Mills, senior markets reporter for Axios. Let's first just talk about the top line number, because 3% annualized rate, you're like, oh, that's a big, good number.
Right, must be a good number, but exactly as you smartly pointed out, John, when you look under the hood of this data, there's some muddiness going on, right? So we had this huge surge in imports impacting the GDP number that you mentioned from last quarter, and obviously that went away because companies weren't doing this pull forward of imports to get ahead of any tariff policies that could be coming down the pike. So now we have this GDP number coming in really strong just because those imports fell off a cliff. So it's not necessarily a sign that we have this amazing economic expansion going on. And you mentioned as well the Federal Reserve having their meeting today. It'll be interesting to see if they signal anything about how they're viewing the consumer and the economy as well.
I'm an avid follower of you now on Twitter. And as soon as these numbers came out, you dug in them and you saw some data comparing what companies are doing to consumers. What did you see?
This is fascinating as a markets reporter because my sources and I are always talking about markets versus the economy and whether one tells you much about the other. Companies are outspending consumers right now, especially the big tech companies. And we're going to hear from two of them today, Microsoft and Meta. They're spending so much money on AI to get ahead in the AI race that they're outpacing the amount of money that you and I and consumers are spending right now. So that's another thing that could be making it look like our economy is stronger than it actually is because those companies are spending so much money to get ahead on AI.
Consumer spending up, but not by a big number, sort of, I don't know what to use the term, anemic pace, but a slower pace, which could factor in. I mean, when the Fed tries to digest this all today, what will they see?
Well, we know they're going to they're going to hold interest rates steady. They don't like to surprise investors. They've signaled they're going to keep rates steady. But what we do want to watch this meeting for is any signal, to your point, about what they're going to be looking at in the future. Are they concerned about any tariff-driven inflation, and will that impact how they think about rates going?